Hi, and welcome to this week's market presentation. Latest news. In the latest developments regarding the war in Ukraine, limited progress is being made towards a peaceful end to the conflict. Two main issues have emerged in the latest rounds of negotiations, with one being the future of the Donbas region, which Russia is demanding Ukraine hand over in its entirety, while Ukraine continues to hold that it is not willing to give up any more territory that Russia does not already possess. The other important factor in these negotiations has been the status of the Zaporizhzhia nuclear power plant, Europe's largest nuclear power plant. Overall, the impact on markets regarding these negotiations remains limited, given that markets are not putting high expectations on a swift end to the war. And as a result, market expectations are for the current sanctions against Russian energy exports to remain in place for the foreseeable future. At the same time, the European Union has finalized the text of the Russian ban of natural gas by October 2027. Within the agreed upon ban, the LNG imports are said to be banned by the European Union by the end of 2026, with pipeline gas by October 2027. Hungary and Slovakia have opposed the move and are considering legal challenges to block the implementation of such a ban, but their options remain limited. At the moment, the final text still needs to be formally approved by the European Parliament and by the European Council. Although given that they will only require qualified majorities, the expectation is that such a ban will be implemented. The impact on markets and energy prices remains to be seen in its entirety. However, we can already assess that the ban of particularly pipeline Russian gas will certainly add structural support to European gas prices longer term by reducing the flow of cheaper pipeline gas versus LNG. On a practical matter, the ban will certainly accelerate the EU diversification towards LNG and renewables, and it will also mean a continued reliance on US LNG exports for its security of supply, which could prove to be an important point regarding the relations between Europe and the US. Overall, markets view the earlier ban of Russian gas to be manageable in order to keep Europe's security of supply intact. And that's why we are not really seeing a noticeable bullish impact on the market. Although the closer we get to the deadlines, we'll certainly see more action and more activity there. Lastly, looking at Japan, the Bank of Japan governor has hinted at a December rate hike with the probability of a rate hike going up to 84%. The rising Japanese rates appear to be signaling the end of the zero-rate borrowing era in Japan, with the higher global bond yields increasing financing costs, with a particular emphasis on the increasing financing costs for energy projects, which could keep the country more reliant on natural gas and alternative sources of fuel, keeping demand in Asia for LNG higher. Weather. Looking at the weather forecast, we know temperatures are forecasted to remain above the seasonal average over the next 7 to 10 days, particularly at the beginning of this week. Precipitation is expected to remain more concentrated along the North Sea and Northern Europe, with limited precipitation across most of Central and Western Europe over the course of this week. Early next week, more rain is expected to come in throughout Northern and Western Europe as well. Looking at average wind speeds here, we see that improved level of wind speeds, particularly at the beginning of this week. But then as we move through the middle and end of this week, we're then expected to see a decrease in average wind speeds across most of Europe before we start to see an uptick once again at the beginning of next week. Microeconomics. Looking at the latest macroeconomic indicators, we note the Q3 GDP figures for Japan, which showed a quarter-over-quarter growth of negative 0.6 percentage points, 1.1 percentage points worse than the previous quarter. On a year-over-year basis, Japanese GDP grew by just 0.6%, down 1.4% versus the previous quarter, indicating the challenges that the Japanese economy is facing. crude oil and LPG. Global crude oil markets saw a slight uptick in the price level over the front month, with WTI prices moving up 2.6%, with Brent up 2.2%. Overall price levels for the year ahead remain near the lows that we saw earlier this year, and certainly at multi-year lows, with WTI still below the $60 per barrel price level and Brent below the $65 per barrel price level. Overall market expectations remain on the oversupplied side of things for the coming year, although the announcements by OPEC Plus that would be halting further production hikes at least through the first quarter of the year, as well as the rising tensions between the US and Venezuela, are certainly keeping prices from falling further. Natural gas. Looking at natural gas prices, we note the bearish price evolution when we look at the TTF price evolution, with the front quarter down 5.1% on the week and the front year an overall 4.1% decrease week over week. The decreases are much more modest further along the curve, and once we move into 2028 and beyond, we see quite limited movement over the past week. But nonetheless, we highlight the bearish sentiment in the natural gas markets in Europe. The bearishness in gas prices in Europe are still in the face of the decrease in gas storage levels that we see here, with storages having decreased to just around 73% on the week, notably below the levels we saw over the last few years. The withdrawal rate over the past week moved downwards to just around 6.5 terawatt hours per day, in line with the levels that we saw last year, but still below the average since 2012. Given the warmer temperatures forecasted over the next 7 to 10 days in particular, we could see that easing withdrawal rate continue, potentially putting some less pressure on the storage level versus previous years. The move towards lower withdrawals over the past week, very much driven by the weather conditions and the decrease in total gas demand across Europe, which moved from above the past 5-year average to now the lowest levels over the past 5 years. The drop in demand then led to a pretty quick response from the supply side of things, with a decrease in the total supply of natural gas over the past 7 days as well, from the peak that we saw a couple weeks back. In terms of the supply mix, the biggest change was in LNG sendouts, in part due to the 13% week-over-week drop in LNG imports. The drop in LNG imports has been driven by two factors primarily. One, the decrease in total demand, reducing the incentive for new arrivals. And on the other hand, which is related, but the narrowing spread between Henry Hub and European gas prices, hurting the profit margins for US LNG exporters. In a closer look at that price differences, we note the spread between European and Henry Hub gas prices having narrowed, particularly over the past week, given the bearish price evolution in Europe and the bullish price evolution in the US. Looking at the spread between US and European gas prices here, we note the shrinking LNG profits, with the spread shrinking to just around $4.7 per MMBTU, the slimmest margin since April of 2021. If the spread drops below $4 per MMBTU, many US LNG exports contracts will be out of the money. And if the margin falls below $2 per MMBTU, we could certainly start to see producers start reducing LNG export and production, as that will be then at their production cost. Overall, investment funds continue to show a bearish sentiment across the market, with the level of short positions increasing over the last couple of weeks, while the level of long positions has eased off slightly. Overall, we see a level of net short positions in the market again for the first time since early 2024. Coal. Coal prices have seen limited movement over the past week, as we've been showing for the last few weeks, really on the Asian side of things. Well, we have noted a slight uptick in coal LNG imports over the past few weeks and month in China. Year to date, we've noted a roughly 14% decrease in overall coal imports to China, in part due to the strong domestic production and also the slightly lower demand from the power sector as the share of renewables increases in China. Over in Europe, the lower coal prices and lower pressure on the market is largely being driven by the low demand for coal, particularly from the power sector, as the low gas prices and high carbon prices is leading to additional coal to gas switching. EU and UK emission allowances. European allowance prices here show limited movement on the European side of things in what remains a bullish price evolution, while on the UK side of things, we've seen a slight drop there with prices decreasing just under 4% over the past week. Nonetheless, both European and UK carbon prices remain relatively high levels, historically speaking, with the percentiles showing roughly a 79th and 83rd percentile respectively. Emissions from the power sector remain on the lower end over the past 5 years for this time of year, very much driven by the lower output from coal in particular, as we get a larger share of natural gas, but also the increase in renewable power output, reducing demand for fossil fuels. The sentiment in the market remains bullish for both the EU and UK markets. On the EU side of things, the tighter supply and demand expectations starting in 2026 continues to keep the level of net long positions at a record high, surpassing 110 million tons over the past week. On the UK side, the big driver is certainly the ongoing discussions about linking the EU and UK carbon markets. Electricity. Electricity prices in Germany saw a decrease over the past week, with pricing decreasing 4.8% for the front quarter, down 4.4% for the front year. The price evolution still remains neutral looking back, but certainly if the decreases were to continue, we could see market evolutions moving towards a more bearish sentiment there. Looking at the price evolution across other European countries, we note that with the exception of Poland, most other European electricity markets have seen a downward movement over the past week. In terms of total demand here, we also see the impact that the weather has on electricity consumption across the continent, with a sharp drop over the past week as temperatures have warmed up. Looking at the power mix, we note the very good performance of French nuclear power generation, one of the main bearish factors in the market at the moment, not just for the French power market with prices for the year ahead at the lowest levels, but also across Europe more broadly. Renewable power generation, while having decreased from the peak that we saw a few weeks ago, remains at the highest levels that we have seen for this time of year. And that has also allowed fossil fuel power generation to remain at the lowest levels in over 5 years. Looking at hydro reservoir levels, however, we do see how the poor performance of hydropower generation can be explained, with multiple countries facing a hydro level deficit versus the 2015 through 2024 average. Looking at Norway, which earlier in the year showed a very significant excess, we've seen that continue to narrow and now showing a similar or the same level versus that average. Lastly, looking at guarantees of origin, here we note the decrease in the price level over the past week in what has been a bearish price evolution, as you can see in the graph in particular. Prices for guarantees of origin have now dropped to near the lowest levels seen over the last couple of years. And one of the big price drivers of the bearish sentiment has been the record high level of cumulative renewable generation in NIB countries so far this year, as you can see here, with total output having caught up to the levels that we saw last year over the last few months in particular. Looking at the different technologies, we note the record high level of solar output, but we also note the improving total cumulative performance of wind power generation, which is continuing to narrow the gap versus the record-setting levels we saw last year. Hydro, as I mentioned earlier, suffering from lower hydro storage levels due to the drier weather conditions so far this year. But nonetheless, output remains in line with where we were in 2023, just slightly below the levels we saw last year. That covers this week's market presentation. Thank you for joining.